Ladies and gentlemen, good day and welcome to the Q2 and H1FY earnings conference call of SMC Global Securities Limited, hosted by XB4 Advisory. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask a question after the presentation concludes. Should you need assistance during the conference, please signal an operator by star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference to Mr. Gautam Kothari from XB4 Advisory. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Thank you for joining us on the Q2 and H1FY26 earnings conference call of SMC Global Securities Limited. Joining us on today's call are Mr. Subhash Chandra Agarwal, Chairman and Managing Director, SMC Group; Mr. Mahesh C. Gupta, Vice Chairman and Managing Director, SMC Group; Dr. D.K. Agarwal, Chairman and Managing Director, SMC Capitals Limited; Mr. Ajay Garg, Director and CEO, SMC Global Securities; Mr. Anurag Bansal, Full-Time Director, SMC Global Securities; Mr. Himanshu Gupta, Director and CEO, Moneywise Financial Services; Ms. Shruti Agarwal, Full-Time Director, SMC Global Securities; Mr. Pranay Agarwal, Director and CEO, StockScart, Moneywise Invest Limited; and Mr. Vinod Kumar Jhamar, President and Group CFO. Before we proceed, please note that some of the statements made during this discussion may be forward-looking in nature and are subject to certain risks and uncertainties. The actual results may differ materially from those expressed or implied. A detailed safe harbor statement is available on the second last page of our earnings presentation, which can be accessed on the stock exchanges and the company's website. With that, I would now like to invite Mr. Subhash Agarwal to share his opening remarks. Over to you, sir.
Thank you, Gautam Kothari. Good evening, everyone, and a warm welcome to all participants on this call. I trust you have had the opportunity to review our Q2 H1 financial year 26 financial results and earning presentation, which are available on both the stock exchanges and our website. Before discussing our financial performance, I would like to provide some context on the broader industry landscape and recent developments that have shaped the business environment. The broking and capital market industry witnessed a phase of consolidation during Q2 FY26 as tighter F&O margin norms, revised expiry cycles, and heightened global uncertainty continue to weigh on trading sentiment. The average daily turnover in the derivative segment declined sequentially, with cash market participation also moderating as retail investors adopted a cautious stance. Several listed intermediaries have reported sequential pressure on their broking income for the quarter. Nonetheless, underlying investor engagement remains healthy, reflected in continued growth in active demat accounts and strong SIP inflows into equity mutual funds. Over the medium term, the industry remains well positioned to benefit from expanding retail penetration, improving financial literacy, and SEBI initiative to enhance transparency and risk management, all of which are expected to support a more resilient market structure. India's non-banking financial service sector continues to demonstrate resilience amid evolving macroeconomic and regulatory dynamics. Industry credit growth is expected to moderate to around 13 to 15% in FY25-26 compared with the strong 17% pace seen over the last 2 years, as per ICRA. The moderation is largely attributed to a calibrated approach towards MSME and unsecured retail lending, following the Reserve Bank's tighter oversight and higher risk weight norms. However, asset quality across large and mid-sized NBFC has remained stable, supported by prudent provisioning and diversified portfolios. Meanwhile, funding conditions remain uneven, with only marginal easing in borrowing cost offering limited relief. Overall, sector growth has clearly shifted from a high growth phase to a consolidation phase, indicating a more subdued near-term outlook for NBFCs. The Indian insurance sector has continued to exhibit strong growth momentum through Q2FY26, outpacing most other segments in the financial services space. The life insurance industry's new business premium collection grew by over 10% YOY in the first half of financial year 26, driven by rising awareness, product diversification, and the continued shift towards protection-oriented and annuity plans. The general insurance segment too maintained healthy traction, with growth led by health and motor portfolios and increased adoption of digital distribution platforms. Insurance broking and distribution intermediaries have particularly benefited from this expansion as corporate and retail demand for comprehensive risk coverage continue to rise. With deepening digital penetration, supportive regulatory reforms, and growing financial inclusion, the insurance industry remains on a strong multi-year growth trajectory. We believe the broking industry is currently undergoing an important period of realignment, one that may appear challenging in the short term but holds significant promise for the future. The regulatory changes reshaping the broking and financial services landscape are fostering strong market discipline and greater investor protection. Though these shifts have led to temporary moderation in trading volumes and earnings, they are setting the stage for a more stable and transparent capital market. For established players with strong governance, technology capabilities, and diversified business models, this transition phase offers an opportunity to consolidate and strengthen long-term positioning. As the environment stabilizes, we expect trading activity and investor participation to gradually recover, driven by continued retail engagement, growing SIP flows, and deepening digital adoption. Meanwhile, our insurance segment continues to benefit from favorable structural tailwinds such as rising financial awareness, broader product adoption, and expanding distribution channels. With our integrated financial services platform, we remain confident of navigating the current cycle effectively and building a stronger, more future-ready franchise. Let me take you through some of the key performance highlights for the quarter. In Q2 FY26, our consolidated revenue from operations stood at rupees 440.3 crores, reflecting a 3.6% quarter-on-quarter growth, supported by a steady performance in our insurance business. EBITDA for the quarter was rupees 84.4 crore and PAT stood at rupees 21 crore, impacted sequentially by softer trading volumes and higher funding costs. Our broking, trading and distribution segment witnessed temporary moderation due to market-wide adjustments following regulatory changes in the derivative segments. Despite this, our client base and distribution network continue to expand. As of September 2025, we had 2,152 authorized persons spread across 412 cities and 6,573 financial distributors, reaffirming our strong pan-India presence. Our mutual fund AUM rose to rupees 4,459 crore, reflecting continued investor trust and steady SIP inflow. Our NBFC arm, operating through 38 branches across 7 states, maintained a healthy asset quality with collection efficiency of 98.47% and a net worth of rupees 485 crore. The overall AUM stood at rupees 1,088 crore, supported by a well-diversified lending portfolio across SME LAP, gold, and onward lending. Meanwhile, our insurance broking business continued its growth momentum, reporting a strong uptick in premium volume and policy issuance. The division operates through 8 branches nationwide, supported by over 16,200 post agents and 370 MISPs, leveraging digital channels to reach new customer segments. The quarter witnessed slower growth and margin correction largely influenced by regulatory changes and challenging market conditions. Nonetheless, our diversified business model, wide geographic reach, and continued investment in technology position us well to navigate the near-term headwinds and drive sustainable growth over the long term. With that, I now hand over to Mr. Vinod Kumar Jambar, our President and Group CFO, for a detailed overview of our financial performance. Over to you, Vinod Jambar.
Thank you, Subhash sir, and good evening to everyone on the call. Let me now take you through our financial and operational performance for Q2 FY26 on a consolidated basis. For the quarter ended September 2025, our operating income stood at rupees 440.3 crores, reflecting a 3.6% quarter-on-quarter growth. EBITDA came in at 84.4 crores with EBITDA margin of 19.2%. Profit after tax stood at rupees 21 crores, translating to a PAT margin of 4.8%. For the segment-wise performance in the broking, distribution and trading segment, revenue for Q2 FY26 was rupees 240.9 crores compared to 276.2 crores in Q2 FY25, mainly due to softer trading volumes and regulatory changes in the derivatives market. Our distribution and client network continued to expand with 2,152 authorized persons across 412 cities and 6,573 financial distributors pan-India. Our mutual fund AUM stood at rupees 4,459 crores, while the broking DP AUA reached rupees 1,42,214 crores, demonstrating strong investor engagement. Online trading now contributes 67% of overall turnover, underscoring the success of our digital initiatives. In the financing NBFC segment, revenue for Q2 FY26 stood at rupees 46.4 crores compared to 50.4 crores in Q2 FY25. The AUM stood at rupees 1,088 crores with a collection efficiency of 98.47%, secured AUM over 65%. The business continues to maintain healthy asset quality with GNPA at 3.6% and NNPA at 2.5%. Our NBFC operates through 38 branches across 7 states, serving diverse MSME and retail segments. In the insurance broking division, revenue grew by 21% YOY to rupees 162.5 crores, driven by robust growth in both life and general insurance. The total gross premium stood at rupees 1,364 crores for H1 FY26, and we sold 4.93 lakhs policies during H1, reflecting continued traction in retail and corporate segments. The business operates through 8 branches nationwide, supported by over 16,200 POS agents and 370 MISPs, with strong digital adoption through SMCinsurance.com. While this quarter reflected moderation in the broking and financing businesses, our insurance vertical continues to be a key growth driver, supported by sustained demand and rapidly expanding distribution network. Our diversified business model, strong digital ecosystem, and nationwide reach positions us well to capture opportunities as market activity normalizes and investor participation strengthens further. With this, we conclude our remarks and open the floor for questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the queue, you may press star and 2. Participants are requested to use a handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all the participants that you may press star and 1 to ask a question. Reminder to all the participants that you may press star and 1 to ask a question. The first question is from the line of Dhruv Parav from DP Investments. Please go ahead.
Hello, sir. Am I audible?
Audible. Dhruv.
Thank you for the opportunity. So, sir, your EBITDA margins dropped from 19.2% to 26.4% year-on-year. What specific cost pressures or revenue mix changes contributed to this decline?
Yes, Dhruv. I'm Vinod Jamar. Actually, EBITDA margin dropped because of two main reasons. I'm talking about 6 monthly number. So one is that our fee and commission income reduced by 35 crores, which is in line with the exchange turnover also. And another contributing factor is our fair value gains on investments, which were around 25 crores in the last half year, whereas this year it is around 7 crores. So these two factors reduced our profit before tax, and accordingly EBITDA also reduced.
Okay, so are these pressures expected to persist in H2?
No, we expect the situation to improve because if you remember, last year in October, SEBI brought in certain changes in derivative segments, and all those activities hampered the business across the industry. So for first 2 quarters, the base was higher, and now we will be growing and market conditions will improve. So we expect next 2 quarters to be better.
Okay, sir. And your PAT also fell to 54% year-on-year in Q2. So could you elaborate on the key drivers behind the decline and when a rebound is expected?
Same reasons which I narrated, 2 main factors. So we expect next 2 quarters to be better.
All right. And one more question. Your borrowing rose from 1,500 CR in March 25th to 1,700 CR as of now. So what portion of this relates to NBFC operations? And how is the cost of borrowing trending?
NBFC, there is not much rise. Actually, we raised 2 series of NCDs. Around 220 crores of NCDs were raised. And that is required for our working capital requirement for the better facilities to the customers and allowing them some credits.
Oh, okay. Thank you for the clarification. I will get back in the queue now.
Sure. Thank you.
Thank you.
Thank you. The next question is from the line of Subhash B. from Value Investment. Please go ahead.
Hello, am I audible?
Yeah, you are audible, Subhash.
Okay. Hi, I've been following you guys from over a year now, and I've been your investor. I think last year, Q4, you were guiding for 20% growth over FY25, right? But looking at the first half, definitely I don't think 20% growth would come either in top or bottom line. Do you think H2 would be so great that you would achieve 20%, or this year will be subdued, or do you want to revise your guidance?
Definitely, Subhash, you are correct. We have said that this year should be better, but unfortunately, as you know, industry turnover has been reduced in F&O and cash market from 15% to 40%. And expense remain the same or on the higher side, and revenue considering reduced. So that has been affected, and so I think. But next 2 quarters we are expecting these 2 quarters should be very good, and perhaps we can recover to the extent we have profits in last year. So we are expecting a better quarter, third and fourth.
Okay, so you're expecting a similar profit compared to FY25, or will it be lesser than last year?
Let us hope for the best. We should achieve with our good working and so many things we are putting in place. So I think we will be able to do that.
Okay, we'll be able to achieve last year's profit. Okay. And also the other question that I had was, when I went to your investor presentation, I could see that due to the SEBI rules, the broking activity has come down, because of which the overall volume and your margins have come down. But what's happening in the insurance industry? Because I can see that EBITDA has come down even in insurance and also NBFC. Even there, compared to last year, year on year, the margins have come down. Why is that, and do you expect that to be similar to last year in the second half of the year?
Sir, the insurance, the performance is almost at par with the previous two quarters. So last year, September 24th half year, we had a PAT of 5.42 crores, and this year it is 5.57 crores. So slightly better than last year. And next two quarters, obviously in insurance, quarter four is always better. So we expect further improvement in the
revenue is consistently increasing.
Revenue is consistently increasing, but it's a low margin business because of motor insurance premium and payouts to the MISP dealer.
Right. So compared to last year, the margins are definitely coming down, right?
There is not much impact. It is just a few points here and there. And if you see, the GST was reduced on certain insurance products, which resulted into what insurance companies did. They made the all commission slabs inclusive of GST. So that also will impact slightly. The commission rates have come down slightly because of inclusive of GST rates.
Does GST affect your top line or the EBITDA level? I think it affects your top line, right?
GST, yes, it will affect top line as well.
Top line only, right? Yeah, but I see that your EBITDA is down by 9.6%, like almost 10% compared to last year, right?
No, EBITDA is not down.
Compared to H125, you can see the investor presentation, page number 6. So you mentioned 9.6% down. EBIT, yeah, it's EBIT. And NBFC is down by 25%.
Yes. NBFC, if you look at the number, the major factor is fair value changes. So last year we had a very good IPO, and since we get the allotment on preferential basis as a financial institution. So last year our income from IPO allotment was rupees 23.31 crores. And this
but I think I got the answer from the previous investor question. Thank you for NBFC question. But what about the insurance, like 10% down?
Just a minute. Let me just...
Yeah, sure.
Down a bit, 9.6%.
Yes. Yeah, it is. Our EBIT is last year was 7.3. Now it is 6.6. Marginally down.
Yeah.
But
the reason being.
But revenue PAT is slightly higher than this.
Oh, PAT is higher. Okay, I think that's all. Those are the questions that I have. So maybe FY26, I mean, if the markets recover well and there is more investor participation, we could see some growth, right? Because, I mean, from 2 years, we could see that definitely your share price is undervalued compared to your peers. The valuation that you're getting is definitely lesser. But now that the growth is also less, I hope, you get the right valuation at least to be at the fair price. I can see that last year profit was 147 crores and until now, sorry, how much is your PAT until H1?
Consolidated PAT you are talking
51 crore.
51 crore.
51 crore, okay. So, in the H2, do you think you would be able to achieve like 90 odd crores PAT?
If market conditions support, we are hopeful to achieve that.
But that's your target, right? 90 odd crores?
In 90 to 100 crores.
Oh, okay. That's great. Great to know that. Okay. Yeah, that's all I have. Thank you so much for answering all the questions.
Thank you.
Thank you. A kind reminder to all the participants that you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Kritika Mehta from Mehta Investments. Please go ahead.
Hi, am I audible?
You are audible, Kritika.
Yeah, so good evening. So thank you for the opportunity firstly. I just had few questions from your business front. One is that your NBFC revenue declined and your EBITDA also declined. So what drove the compression and the decline in the AUM particularly?
Yes. Hi, Kritika. I'm Himanshu Gupta. So the main reason for the decline in revenue are twofold. One is the dip in the fair value net gain on the fair value changes on the investment, and second is there is a slight dip in the AUM of the company, and therefore the interest income has gone down. So basically the reason for dip in AUM is that we are the main reason for the dip in AUM is that we have discontinued the Prime Lab product where we were getting low spread, and that we are shifting that Prime Lab book to the Micro Lab book. So that is one reason. And secondly, considering the market situation, we have tightened the underwriting policies for the unsecured product. So therefore, the disbursements have gone down in those products. So these are a couple of reasons for the dip in AUM and therefore the interest income as well.
Okay, and another would be the gross and the net non-performing asset has also rose slightly to 3.6 and 2.5% respectively. So what would be the reason for the same?
So if you compare, with the last quarter, so it is, almost on the same line. The main contributors to the GNPA are few, secured accounts, wherein we have adequate collateral, but, it is taking some time for the recovery due to the, the legal and recovery process which is involved, and we expect, good recovery out of that GNPA, and we have made adequate provisions on that portfolio.
Okay, and also the SME working capital loan, term loans form 35% of the portfolio. So is your company planning to rebalance toward the secured or short tenure assets?
Not short tenure really, but this is the business loan that I was referring to, that we have tightened the underwriting policies for the unsecured product. So this is the unsecured business loan product that we offer to MSME customers. And this is a conscious call by us. Over the last couple of years, we have reduced this exposure from over 50% of AUM to 35% today, and we plan to reduce it further to below 25% in over next year or so.
Okay. Yeah, thank you.
Thank you. Ladies and gentlemen, as there are no further questions, we have reached to the end of the Q&A session. Now, I would like to hand over the conference to Mr. Mahesh C. Gupta for closing comments. Please go ahead.
Yeah. Thank you all for taking the time to join us today. We hope we were able to address your queries and provide useful insights into our performance. For any further information or follow-up, please connect with our investor relations partners at XB4 Advisory. Stay safe, and we look forward to interacting with you again next quarter. So thank you once again. Thank you.
Thank you.
Thank you. On behalf of SMC Global Securities Limited, I will conclude this conference. Thank you for joining us, and you may now disconnect your lines.